The Federal Reserve is widely expected to keep rates on hold this evening after 3 rate cuts so far in 2019. Tonight's focus is on the FOMC's economic projections and the news conference from Fed Chair Jay Powell. But is his assessment of the economy overly optimistic? Markets continue to digest the latest developments on trade as focus turns to the tariff deadline on Sunday, which looms large. Good evening, this is IGTV and welcome to our special coverage of the Fed's interest rate decision. We're here to help you trade the FOMC announcement and the markets following the release. Almost every economist on the street is expecting rates to remain unchanged at the conclusion of its 2-day policy meeting announcement in a few minutes' time. It's also expected to signal that rates will remain around current levels throughout most of 2020, the year of the presidential election. Along with the rate decision and its policy statement at 7 p.m, we'll also be looking out for the Fed's latest economic projections. And half an hour later, Fed Chair Jerome Powell will hold a news conference fielding questions from the press. The Fed has cut interest rates 3 times so far this year. The latest decision was in October, where it cut to a range of between 1.5% to 1.75%. The FOMC said in October only a, quote, material shock to the economy would lead to a tweak in rates. This year has been seen as the monetary policy U-turn from normalization to accommodation, not just from the Fed, but from other central banks around the world. Let's check in on the markets ahead of the FOMC announcement in just under 15 minutes' time. There you go, the major averages stateside, the Wall Street cash underperforming there, while it's the Nasdaq or the US Tech 100 cash up by 0.25%. Now let's have a quick check on the US dollar crosses as we await the key interest rate decision from the Federal Reserve. You can see it's pretty much flat for euro dollar and dollar yen, but it's the pound that's rallying against the greenback ahead of the UK general election today. Of course, a jittery day for the pound, but this evening we'll be focusing on the US dollar. Joining us for the show tonight is IG's senior market analyst, Josh Mahoney. Josh, good to see you. So it's pretty much a given that we're going to have no change on rates. So what is it that we should be watching for tonight?
Yeah, exactly. I mean, look, by and large, markets aren't expecting any sort of shift from any of the committee. And certainly the big question here is, where are we going to see a shift? We may not necessarily see a shift whatsoever, but certainly at least we're looking at a meeting where we see a number of different things coming out. We of course, see projections in terms of growth and unemployment. We see the new dot plot as well. So certainly, are we going to see a shift on that front? Are we going to see a shift off the back of the fact that we've, of course, seen some stronger economic data recently? Of course, today we've seen some CPI coming out in terms of inflation. We've also, of course, seen recently the jobs data coming out of the US, of course, particularly strong. So where are we going to see the shift? There may not necessarily be a shift, but if we do see a shift, then that is at least going to set us up for 2020 and possibly point towards a potential move in terms of rates.
Now, economists are unanimous that the Federal Reserve will leave US interest rates on hold, but what will the message that the voting members on the FOMC will be wanting to impart? Earlier, my colleague Jeremy Naylor caught up with foreign exchange analyst Justin McQueen from Daily FX and began by asking him what will come out of the announcement. Take a listen.
I think overall for the Federal Reserve, really it's a sort of a wait and see. Like you said, that we are expecting to see rates left unchanged, and given the fact that we have already seen that mid-cycle adjustment of 75 basis points worth of easing. And so ultimately, take into account in terms of a lot of the data that we have seen, we expect the Federal Reserve to stand pat on monetary policy.
What about the dot plot? What's that telling us going into this meeting? How has that changed? Because with this drop in interest rates, 75 basis points we've had taken off the base rate.
I mean, ultimately, with the dot plot, we see it pretty much as a sort of mechanical sort of adjustment on the basis that the dot plot actually signalled unchanged rates for 2020 at 1.9%. However, though, we are technically below that level, so therefore we'd expect the dot plot to reflect the cut that we've seen this year.
Yeah, you referenced the economic data that we've seen. Of course, last Friday's jobs data was extraordinary. It stood out because of its strength, and this was interpreted very positively by the dollar. Very positively, of course, as well by the equity markets immediately after the number came out. I appreciate that one number doesn't change the direction of the Fed, but what sort of impact does that sort of figure have when it sort of vindicates to some degree Jerome Powell's positioning on interest rates?
I mean, I think ultimately, yes, like you said, with regards to that NFP data, it really sort of, for the Federal Reserve, it sort of emboldens their view that growth is still relatively moderate and that ultimately that they do see monetary policy as appropriate as it is now, unless there is a significant deterioration in the US economy. And then, of course, they can keep the door open to further easing.
Yeah, and what about the influence of Donald Trump? As I said, that we've got this setup from Donald Trump. I mean, he's very free with his tweets, but has put a lot of pressure on the Federal Reserve. And of course, a lot of the questions have been around whether or not Jerome Powell actually has one eye on what Donald Trump is saying. The Federal Reserve should be independent of the White House. But do you think there has been undue pressure being brought to bear on the Federal Reserve from the White House?
Definitely, I do agree with that. And I think as well, of course, market participants in general have one eye on Donald Trump on the basis that, of course, his sort of rhetoric towards China in regards to the trade war can, of course, impact financial markets and, of course, the Federal Reserve's decision. So, again, as we do approach that sort of December 15th tariff deadline, of course, if they are not delayed, then we could see the Federal Reserve perhaps in the new year start to open up to the basis of doing another cut to accommodate the expected deterioration in sentiment.
One final question at Daily FX. What trades will you be watching around this release today, assuming that we get things as expected? Is there a trade to watch out for in your mind?
I think really the sort of case for us would be to look towards sort of euro-dollar. At the moment, we have been pushing slightly higher. And again, if we do see somewhat positive comments from the Federal Reserve, unchanged policy, then we could see a bit of a pullback. And keep in mind as well that we do have tomorrow, we do have the ECB rate decision. We'll see the first comments from Chief Lagarde as well.
Now, still with me on set is IG's senior market analyst, Josh Mahoney. Now, Josh, pretty clear we're not likely to get a rate cut now or even before the end of the year. But when it comes to next year, it seems that analysts are quite divided as to how many cuts we're going to get, if any at all. Goldman Sachs, for example, saying that it's likely to see rates remain on hold throughout the year. UBS, quite in contrast, predicting rate cuts in March, April and June. So I'm wondering where you stand.
Yeah, well, I mean, you know, we were talking about the dot plot, and that should really give you a guide on where people should be looking for interest rates to go. By and large, that doesn't necessarily point towards much in terms of 2020, but there is a possibility that as we see this strengthening in terms of some of the economic data, then you're likely to see the possibility for people to start looking towards a potential rate hike in the next year. So certainly 3 rate cuts in the next year, I definitely don't see that coming personally. I think, interestingly, what we can bring up here is the interest rate probability. This is on the Reuters platform, and you can see on the bottom left currently for this meeting we're pricing around about just a 4.6% chance of a rate hike, 0% chance of a cut, 95% chance of no change. By and large, what's interesting here is that you can see that on the left-hand side, the probability of a cut actually does increase as the year goes on, but in terms of a hike, we don't necessarily see that. Now, I'd be interested to see whether some of the commentary coming out today, whether it be the commentary or the dot plot, is going to potentially shift these expectations that we're seeing within the markets and point towards a potential for a rate hike. And ultimately, I think the one thing that belies all of this data is the fact that we've still got to find the conclusion to this trade war. If that trade war rhetoric, if we get the same stance that we've currently got just going on and on and on throughout 2020, of course, it's going to be likely that we're going to have to see further rate cuts. But we could see a breakthrough tomorrow for all we know, and that could lead us into a position where all of a sudden the Fed feel like they're emboldened to actually start normalising rates even further. So, you know, behind all of these releases that you're going to get and predictions and everything, it all really comes down to what's happening in terms of that trade relationship with China.
Well, of course, and we've got that 15th of December deadline looming large on coming up this weekend on Sunday. I'm wondering what you're expecting there. Obviously, it seems as though we're very unclear as to whether Trump is going to extend those tariffs on Chinese consumer goods or not. The markets have been very, very jittery this week around this. What's your kind of base case?
Yeah, look, I mean, it's difficult because, you know, everyone, including yourself, that we're talking to around the office is saying, oh, you know, well, look, it'll get done before that deadline. And it does seem like that's the kind of thing that could just take a single phone call with Donald Trump and all of a sudden he'll tweet out to say that they're going to extend it. It doesn't necessarily feel like there's a huge process to actually extending that deadline. Of course, it would be a gesture of goodwill towards actually moving towards that first stage agreement. But the base case and the current default scenario is that we, of course, see that deadline hit, and of course then we see that ramp up in terms of tariffs. So certainly I think there is, of course, a very strong chance that we do see that deadline extended. But certainly in terms of traders, it's worthwhile noting that for the days ahead, we're likely to see in terms of equity markets, those fears really start to play a greater role until we actually do see a breakthrough, if we do see a breakthrough or announcement to avert that deadline. So certainly it's going to be something that's going to be playing a much bigger role as we see the end of this week come to the fore until we actually see some sort of announcement. So volatility does seem to be ahead, irrespective of what direction it comes.
Yeah, so in terms of sort of US equity markets this year, they've had an extremely strong performance, a lot stronger than many were expecting, but a lot of that was to do with the major sell-off that we had in the fourth quarter of 2018. So we were starting from a very low base. I mean, if we don't get that kind of trade agreement past the line, at least the first part, is that the key risk that we could have a repeat in the fourth quarter, at least the back end of the fourth quarter, as we did this time last year?
Yeah, there is a possibility. I think that markets by and large have been relatively optimistic in all of this. If you were to say before Donald Trump came into power that you would have this amount of time spent sort of breaking or building up barriers between the likes of the US and China, you would think that we wouldn't necessarily be in this position. Of course, record highs for the likes of the Dow and the S&P.
Yeah.
But markets certainly over in the US have, of course, been looking at this with optimism because US companies, by and large, would be expected to gain the most out of this kind of scenario if we did see this trade deal put across the line. And of course, in terms of traders, everyone wants to get in on that deal before it actually gets announced. So you've constantly seen these tweets coming out from Donald Trump and everyone wants to react to it because they think this is the breakthrough. But it never seems to be the breakthrough and it just keeps carrying on and on and on. So, I think if we don't necessarily see that breakthrough, I would like to think that, people would actually sort of be skeptical enough to actually say, yeah, no, it's not going to happen. But, we've seen time and time again, markets are always relatively optimistic about this and they always want to get in on it. So I wouldn't necessarily be surprised to see markets relatively elevated as long as we see this continued rhetoric from the likes of Donald Trump saying that they're not too far away from a deal.
All right, so let's move on from some of the fundamentals for a minute and take a look at the technicals. Obviously, our audience very keen to know how to trade this announcement. We're not expecting much in terms of the actual rate decision. What are you seeing on the US dollar index in terms of key levels? What should we be looking for? Where do you see the potential move around this decision? Not necessarily at 7 p.m, but potentially with the press conference. Sometimes we get a lot of volatility in the markets there when we get the questions from the press.
Yeah, certainly. I think what we can see here in terms of the dollar index is the weakness that we've seen over the past couple of weeks has taken us back into this trendline support and crucially this 96.72 support level. If we break below that, all of a sudden it starts raising question marks about the possibility of a major breakdown for the dollar index following this big ascending wedge that's been playing out throughout certainly 2019 and also the back end of 2018. So certainly there are some question marks to be asked here at around about this 96.72 if we do break that level. Now bear in mind, of course, we've been seeing economic data that could point towards a little bit more of a hawkish stance from the committee, and of course that should buoy the likes of the US dollar and the dollar basket. So given the fact that we're coming in towards this crucial area of support and this trendline support, are we going to see some sort of rebound around about this announcement? Certainly it's going to come down to exactly the sort of outlook that we do get, and in terms of the dot plot. Again, back to the daily time frame, we can see here this double top formation following what now looks like a retracement. Didn't necessarily hit that 61.8, but continuing to deteriorate. Like I said, that 96.72, really a key level to be looking out for. Justin was mentioning earlier the fact that we've got the ECP to think about as well. Now, bear in mind that the heaviest part, the heavily weighted part of the US dollar basket is the euro. And certainly as we're moving into a new leadership over at the ECB, where the focus may not necessarily be so much on constant easing, but more on the likes of fiscal stimulus, are we possibly going to see some strengthening in terms of the euro? And that could potentially be to the detriment of the dollar index. So certainly, as we're seeing this decline, we're getting relatively close to this 96.72 level. We can either rebound from this area and from this trendline support, or if we break that support level, I do think there is a possibility we could see a significant decline for the dollar index.
And very quickly, not long to go until the announcement, but if we could take a quick look at the US equity market, maybe the US 500, just have a look at some key levels to watch there. I mean, we know there's that correlation between the hawkishness and dovishness and a move higher and lower. So perhaps you could kind of tell us about what's going on in terms of the levels today. What are traders doing as they prepare for the announcement?
Yeah, certainly. I mean, you can look. I mean, ultimately, the trend is a bullish one. We've seen this big rally recently regaining ground. Didn't necessarily manage to retake that prior high, 31.57. Then more recently, seeing this sort of consolidation with sort of trickling lower. For me, I think this is likely to be a precursor to another leg higher for this market. You can see the sharp ascent that we have been seeing throughout the beginning of December, now seeing these slight declines.
All right, I'm just going to interrupt you there because we've got the decision. The Fed keeps interest rates unchanged as expected at a range of 1.5 to 1.75%. It says it sees no change in rates in 2020. So a little bit of forward guidance there. It says the policy decision was unanimous. Now, it also says the median forecast of Fed policymakers is for one rate hike in each of 2021 and 2022. But individual forecasts varied widely. The median forecast of Fed policymakers is for no change in rates in 2020. 13 out of 17 see rates unchanged. 4 sees one rate hike. Now, let's have a quick look at the dollar, Josh. What are we seeing there? I mean, it's pretty much as we expected. No change to the key policy rate.
Yep, interestingly enough, we're actually also seeing that shift in terms of market expectations now pointing towards a 0% chance of a rate hike in the forthcoming months. Now, certainly, if we look at the dollar index, you can see here, this is the 5-minute chart, so certainly that short-term picture. We're seeing a tentative bounce here. Of course, this is relatively small, not a huge move. But of course, we were talking about the fact that we've come back into this crucial area of support. So is this going to be the beginning of some sort of move towards the upside? You can see with that move fading already. So certainly not necessarily having too much to back up that move. But certainly as we move towards this phase where 2020 isn't necessarily going to see a cut or a rate rise, you can look at the previous market expectations. Markets had been looking for a rate cut. We didn't really have much expectation for a rate rise. Now we're looking at 0% chance of a rate rise. But on the cut side, are we seeing enough of a shift to be moving this market towards a downside? You can see here we're pretty much back down to the lows and creating fresh lows now. So certainly that initial rebound appears to have pretty much been sold straight into. So again, threatening this wider trend back to the weekly time frame. 96.72 is that key level. Now that we're turning lower once more, we are certainly going to possibly threaten this support level and potentially break lower if we were to break that 96.72 mark.
Okay, so just bringing you up to speed with a few more lines coming out of the Fed. The Fed says that it's now dropping from the prior statement, the language that says uncertainties about this outlook remain. So obviously the Fed feeling a little bit more robust about the outlook for the US economy, which kind of ties in with some of the economic data that we've been seeing recently. The Fed also says that it judges that the current stance of monetary policy is appropriate to maintain the US economic expansion and inflation and employment goals. Now, Josh, I was just reading one piece earlier that was suggesting that Mr. Powell might be being a little bit too optimistic. I mean, given the fact that we have got that huge sort of uncertainty around the trade tensions, and we know Mr. Trump is notoriously kind of unpredictable, is the word I'm looking for. Very unpredictable. I mean, do you think that he could be going a little bit too much the other way now?
I think, look, we've got higher interest rates over in the US compared to some of their peers, but that does make sense because you've seen growth outperforming in that area compared to the likes of the UK, the likes of the Eurozone. So it makes sense their interest rates are relatively high in comparison. And of course, we've seen these sort of 3 insurance cuts recently, sort of bringing them a little bit more in line with some of the other areas. Certainly, look, ultimately, the Fed can't really do much about this trade war, and they can only really position themselves for when they see either a major breakdown in terms of the economics, or if they see a major breakthrough in terms of the trade war and they see a sign of a big uptick. You know, and until that happens, really they can just presume that the market's going to remain fairly steady as she goes at the moment, and then just be able to react to it in the future. So I don't necessarily think that there's much more that they can do on this front. You can see that they're feeling a little bit more confident about their view here at the moment because the numbers are looking relatively strong. But certainly, you know, I don't necessarily think that this is too bad from the Fed. I think, you know, they're obviously showing that they're not necessarily going to bow to the pressure of Donald Trump, despite the fact that he's mentioned he wants to see negative interest rates. Quite why that would happen, I don't know. But certainly, the US economy seems to be doing all right at the moment. They're waiting for that sort of breakthrough on the trade war, and then they can start adjusting accordingly. But they can't really start saying what's going to happen on that front, because quite frankly, they're not necessarily in those negotiations.
All right, now just very quickly, I want to bring you up to speed with the latest FOMC economic projections. GDP growth coming in line with the previous estimate, which is 1.9%, so that's unchanged there. PCE, that's the Fed's preferred measure of inflation, remaining at 2%, same as in September. The jobless rate, however, a little bit better, 4.1 versus the previous expectation for 4.2. But let's have a very quick check on the market reaction before letting you go, because we did see that little bit of a spike in the US dollar. Here's how equities are trading. You can see that the US Tech 100 cash is now extending its gains from when we took to the markets earlier, now up by 0.4%. The Wall Street cash continues to be the laggard, trading just below the flat line. Let's have a quick little look at the US dollar before we go. This is euro dollar, a little bit stronger, same as before. Dollar yen just a little bit flatter, and it's the pound that's the real outperformer today. A very volatile day for sterling ahead of the UK election. That's all we have time for today. Thank you to my guest, IG's senior market analyst Josh Mahoney, and thank you for watching our special programme on the Fed's rate decision. I'm Victoria Scholar, and remember to find me on Twitter for more updates. I'm at VictoriaS_IG.